can't make it tonight, I'll record this. So we've certainly been through a lot over the past couple of decades, and I think that one of the important things, and probably the only slide that a lot of people remember, is this one, that in all these difficult times, and the wars that we've been through together, the financial crisis, the European crisis, energy crisis, and now COVID last year, and that we're still dealing with, we've continued to provide income to our clients. So although the market value is always up and down and up and down, and we certainly have done well over the last couple of decades, the important thing is Pepsi kept paying their dividend to us, and the companies we own kept providing income to us so that we could remain retired, or if you're like me and still working, and hopefully for the next 30 years I'll be so, you just keep reinvesting those dividends to increase your future value. And so although none of us know what the future may bring, and I don't know if the stock market's going to sell off tomorrow, next week, next year, I have a lot of certitude that the companies we own will continue to pay you and keep you in the comfortable retirements that you have had over the last couple of decades. So with that, and the same was true during COVID. When you look at this graph and expand it out, the income to our clients stayed very steady for us, even when the market sold off horrifically and all of our portfolios were lower during that downturn. Now, valuation is a concern I hear from a lot of you, and our advisors.
Jim, we can't see a graph. Jim, are you trying to show us a graph?
Yeah, can you not see the graph?
I don't see it. I don't see it, Jim.
Let me unmute everybody. Can anybody else see
I can see it. I can see your presentation.
Okay.
We see the slide with the company logos, not a graph.
Yeah. Okay. So it may, Bob, it may just be, I'm not sure, maybe the way you have the camera set up, but you could try moving it around a little bit. Hopefully that, I'm recording it too, so you'll get these slides. But one of the things that, and I wrote about this in my book, in 2018, I was already writing about this. This imbalance is very concerning to me. So you'll hear about the imbalance of the market, and is the market overvalued? And I would agree, yeah, the market is overvalued, but I don't believe our stocks are overvalued. At 15 times forward earnings, you could literally, all of the companies that we own, all 75 of them, have a smaller market capitalization, and that includes McDonald's, Pepsi, Dow Chemical, Exxon, Eaton, Kraft, all of them. All of these companies are outweighed by these few names: Tesla, Facebook, Netflix, Amazon, Apple, and Google. And these companies, because there's this proliferation of indexing that's going on across the economy right now and across investing, you're seeing just this massive push, and the big have gotten even bigger. It becomes a self-fulfilling prophecy. And I don't know how this is going to end, but I don't think it's going to end very pretty. When I was on Fox Business News before COVID, just before COVID, this was in December or January, I was talking about this. And at that time, these companies were 17% of the economy. And the anchor, she asked me, she said, 17%, I can't believe it. I said, yeah, 17%. Now it's over 25% now for these few companies compared to the rest of the S&P 500. So effectively, when you hear about the S&P 500 or the market going up, it's really going with these few companies on a day-to-day basis. And the algorithms that are driving the market are schizophrenic right now. There'll be days like yesterday when these companies are all selling off heavily and our companies are holding up fine. And then there'll be days today when they're both down, or there'll be days when, especially when the Delta variant is pushing forward and it looks like these companies are all going much higher because people are pushing into what they know has worked during the COVID time period. But we won't participate in the madness of these, jumping on board these companies. In fact, we just sold Apple, which when we bought Apple, it was selling at 13 times earnings and paying almost 2% dividend yield, and everybody hated it. And this year, not having to worry about taxes, even though we made money last year, the government thinks we lost money because we tax loss sold inside of your accounts. And that way I was able to sell Apple without any tax ramifications for us. And we sold Microsoft a few years ago. And I don't know if Apple's going to keep going higher. We purchased it and replaced it with Gilead, which is yielding more than 4% dividend yield, and healthcare I think is selling at very reasonable multiples right now. I don't know if Apple's going to beat out Gilead over the next year or two, but I don't want to own a company that's that expensive. So we're going to tend to avoid these companies. And you can see this is not new. I mean, when you go back to 2000, the companies that were the largest in the S&P 500 were names like Microsoft and GE and Cisco and Walmart, Exxon. If you go back to the 80s, those of you who can remember the 80s, as I do, the largest companies were a lot of energy companies. Those companies are no longer even close to the largest companies on the planet anymore. And they've been overtaken by these huge tech companies like Google, Alphabet, Amazon, Microsoft, Apple, Facebook. And these things tend to rotate. If you had invested in the largest company in the world at that time, you could see that was a very bad investment to make compared to the overall market. So what this slide shows is if you invested in the largest company, back in the 70s, which was likely Exxon, and then you did the same where you just bought what was big and what was moving and what everybody on Wall Street is touting, what everybody on Wall Street is talking about on a day-to-day basis, like my neighbor Jimmy Cramer on CNBC. Whatever they're talking about are usually the largest companies. If you had invested in those companies, you didn't do very well over the last 30 or 40 years. So we're continuing to avoid those companies. And to skip ahead, and just to show you this massive growth outperformance of value over the last decade. I mean, look at this. The last time that growth outperformed value by this much was during 2000. And we know what happened back then. In 2000, I couldn't own Cisco or Microsoft or Intel. We purchased them when they became reasonably priced and started to pay a dividend, and Microsoft. Back then, those were the largest companies that had extreme valuations, and growth stocks were all the rave. And of course, value stocks, cyclical stocks came back. Now we've had another decade of massive outperformance of those kind of companies. And I don't know if this is going to continue this year. What started out earlier in the year was these stocks, our stocks, value started to outperform. But the rest of the story, as Paul Harvey used to say, growth stocks again have roared back in the last 6 weeks or so. So this graph, if I were to complete it, would be even again with here. And if I show you the next slide here, generally cyclical stocks tend to outperform when you're coming out of recessions. So once we kind of get out of this Delta variant, I think we're going to be okay. And so the two big concerns I have right now are twofold. One is COVID. Our economy is going to go with COVID. And if you look at the stats, this is just from the CDC site. You really have to go back 100 years. You have to go back to the Spanish flu and know that it took about 2 years for us to recover. And going into COVID, we were only at about 50% stocks in your portfolio and mine. But I used the downturn last year for us to purchase a lot of stocks. So now we're at 75+% stocks, which turned out to be very good for us when we were buying everything. When Wall Street people are panicking and there's blood on the streets, the cold-hearted economist of me is generally buying, and that's what we did. It's not easy to do, especially when everybody is panicking, but it's paid off nicely for us. Because at the time I felt like we're gonna work through this. I thought it would be much longer than it did, but due to the unprecedented federal response, both fiscal and monetary side of we recovered much more quickly than we have in previous recessions. And I'll actually show you a slide on that too. But the good news is that with COVID, you can see we kind of got things under control, really, especially after vaccines kind of got put out there. However, we had this Delta spike that you see going on right here. So it's something I've been watching closely, and I'm really glad to see that we kind of looks like we may have peaked, I hope, at this level, and that we don't see further spiking going on. And that's directly in relation to the amount of, if you just look at, for example, vaccinations. The vaccinations have clearly had an impact on, as the vaccination rate has gone up, the deaths have gone down. Of course, we still have a lot of people who are unvaccinated, and that's kind of enabled some of this cause here. But we're seeing more people get vaccinated. So with that, more vaccinations, we'll see the death rate go down. Unfortunately, the unvaccinated are still at risk, and that's going to keep the death rate quite a little bit stubbornly higher. But regardless, I think, and here's just one more slide showing that, because I'm just the economics statistician, and that's just what you're looking at. Again, kind of showing the total deaths in the United States, and the deaths have flattened significantly since vaccinations have gone much higher. And with the booster shots eventually coming out and more people getting vaccinated, I think we'll get this under control. So my first biggest concern is COVID. It's been a concern to the market, and that's why you've seen the market kind of get some jitters and shudder here recently. But I think eventually, looking longer term, that COVID will get in check. The second thing that is concerning, and I'm watching very closely, is inflation. And so when you look at inflation, let me pull up the inflation chart here. My last chart, when I sent this to you, inflation was it wasn't too bad yet. Wage inflation, as you can see from this chart, wasn't too bad yet. And 5-year forward-looking expected inflation wasn't too bad yet. Well, if I showed you real time, if I pulled out any of these numbers, like the PPI or the CPI or the PP index, let me just show you the PPI here. We're seeing inflation, and you're seeing inflation. You're seeing it when you go to the gas pump. You're seeing it, when you go. If I pulled out a max chart here, this is very high, right? We're hitting almost 8% for the PPI, which is the producer price or index, and then the CPI is right here. Pull this one up. Even if we pulled out the core CPI, which strips out energy, the more volatile energy and food prices, you'll see that the core CPI is quite high, and this is problematic. And the Federal Reserve is watching this very closely, because the Fed's number one job is, it's a dual mandate, unlike Europe where the ECB has only inflation to worry about. Our Fed has a dual mandate to ensure price stability, number one, and full employment. And so they're watching this very closely. The good news is we economists have two great periods in history from which to learn from. The first being the Great Depression, that we want to use Keynesian economics, or this COVID, or the financial crisis, where we can stimulate the economy, but that's the old pushing on a string analogy of when, just because the federal government's throwing a lot of money in us doesn't mean businesses are going to borrow it and that we're going to spend it. And then we have the early 80s, which you'll remember, when we had 16, 18% CD rates, and Paul Volcker, the Fed chairman at that time in the Reagan administration, decided to increase interest rates dramatically to stifle inflation. Well, stifling inflation is very easy to do. All the Fed has to do is start raising interest rates, and businesses will stop borrowing, and it will force a recession, though. And when you have a higher inflation, it's very insidious, though. It's bad for bonds, it's bad for stocks. There's nowhere really to hide. So the Federal Reserve realizes this, and they will work quickly to, one, and you've heard the Fed change the language, start the tapering, the bond purchases, and then two, if they have to, they'll start increasing interest rates relatively quickly. And that's where, when you see, Fed expectations, like here, the Fed was initially saying, we're not going to raise rates for a very long time. You can see out to 2023. They're still sort of saying that, but they'll start to taper first, probably later this year, hopefully later this year. And then if they have to, they can raise interest rates quickly to stifle inflation. So I don't have as much concern about inflation, because the Fed can really cut that off. And we have, again, the example of, although it's not politically, if you go back to the Nixon administration, it's never politically viable for any administration that's in power for the Fed to be raising interest rates. Anytime the Fed is raising rates, it's harmful to whomever is in control. You remember it probably cost George Bush, the first one, his presidency, when the Fed and Greenspan was raising interest rates. And of course, when the Fed doesn't and keeps rates too low, it can be inflationary, and that caused problems in the early 70s, when you remember when we had an energy crisis. And the Fed chairman at that time during the Nixon administration kept rates too low for too long. So it is easier to fight inflation, though, if we have to. However, the other side of the coin is that we have all these jobs, which has not recovered yet. If I pulled this chart up in real time here and pulled up, you'll see last week the economic numbers were quite disappointing. We were expecting 600,000 plus jobs, and we only had 243,000. And a lot of that is due to the federal government effectively paying people to stay at home. And that's running off now. That ran off this week, where we won't be paying people extended. Kids are getting back to school, and people are going back to work again. I mean, my son Augustus was making $30 an hour as a busboy in Montana at a restaurant. $30 an hour. And the other son was making $14 an hour just putting sleds on the mountain. Just doing the alpine slides down, and because they could not find workers, and a lot of restaurants were shut. And you're seeing that all over the country, wherever you live. This has been an issue in Montana. It's an issue in New Jersey. It's an issue in Milwaukee. It's an issue everywhere. And that's going to run off, though, and we'll see people slowly be forced to get back to work, or to be removed from the workforce, where they go to the unemployment ranks, where they're permanently unemployed, where they decide to retire or not work. And what's interesting is this has been the only time in history, and I've shown our team this, they see this slide a lot, where we've had actually higher spending during a recession. I don't care how far you go back. You can go back to the 1940s. You can go back to the early 1900s. Anytime you've had this gray line of a recession, you'll see that the brown line, personal income, and the green line, personal expenditures, goes down. Doesn't matter if it's the 1960 recession, the 1970, 1973, 74 recession. The 1980 recession was a stark decrease in expenditures. Every recession, the financial crisis, except this one. Look at this. This is crazy, right? Expenditures actually went up a little bit. They declined initially because we were all shuttered in our homes, but it actually spiked a little bit higher. Now, people were saving some of that money, so they got their balance sheets in better. But look at the income, went up dramatically. Well, why did the income go up? Well, the federal government just said, here's a lot of money, guys. To small businesses, they gave out the forgivable loans, and a lot of our clients got that. And then to individuals, they just sent out checks. And so that enabled personal income to actually increase during a recession, which has never happened in our history. And because of that, people didn't have to go back to work, right? Especially because we had extended unemployment benefits. But again, that's going to draw down now. So to me, this isn't a concern that we'll have to see continue for some time. Now, the debt, I know the debt is a concern for a lot of people, and Republicans love to spend money, and Democrats love to spend money even more, right? So I'm not a Democrat or a Republican. I always try to call balls and strikes evenly. This issue does not bother me as a capitalist or as an investor for you. As patriots, I know all of you worry about this issue, and there's a lot of debate about what's the right amount of spending, and certainly we're over 100% debt to GDP, which is, at higher levels than we were during World War II. And I don't know, I wrote a blog about this a year or so ago, Is America Going Broke? And Japan's been at 200% debt to GDP for a long time, and maybe those who believe in more government spending are right. I mean, a lot of the companies that we lend money to have 300% debt to their income, meaning a company like Goodyear Tire has 300% debt to how much revenue they generate. If you're a young doctor, a bank, let's say, Bank of America would be happy to lend you $1 million for a new house. If you're a young doctor making, $400,000 a year, a bank would be happy to lend you 3 times that, 300% debt to GDP. And of course, if 5 years later, if the bank came back to the doctor and said, hey, can you pay me back for your $1 million house? The doc would say, I don't have $1 million, but I've got a $400,000 salary. I can pay my current income. Well, that's like a lot of the companies that we lend money to, where we're getting that 4 or 5% return on the bond side. And so that's a big question mark of how much is the right amount of debt. Certainly, we've seen, nobody wants to bring back the Carter administration. Back in the late 70s, we only had 30% debt to GDP. And during the Reagan administration, you'll see here, we started increasing our debt significantly to fight off the Soviet Union at that time. And the Clinton administration brought it down a little bit. And then Bush kind of raised it up a little bit. And then, of course, the financial crisis, Obama exploded it. And then Trump exploded it even more during COVID. So this is where we are today, and again, capitalism will find an outlet somewhere. At some point, the world might say, America, we're not going to lend you money at 1.5% treasury yields because we're worried about your debt, and that could be very, very detrimental to America. Right now, we're in an enviable position that we have a higher interest rate than much of the world. Some of the world still has negative interest rates, like Switzerland and others, and we're in a good position in that we have a high tax rate because most Americans are not yet leaving America to go to some other country. They're leaving states. They're leaving New York in droves, and they're going to places like Florida, and they're leaving California in droves and coming to places like here in Montana. So we in America at least can kind of move around and fix our state income tax if we don't like the state we live in. But most people haven't gotten to the point where they've left America. And some have, right? I think the Google founders did that. They're no longer Americans, and they've left. But most people stay here in America. If we confiscated all the wealth of all 700 billionaires, if we threw Oprah in jail and threw Elon Musk in jail and threw all those guys in jail, we still wouldn't have enough to pay for the $3.5 trillion in spending that they want to pass right now. Whether or not that goes through again, I don't think so. I think some of the moderates are kind of holding it, but I wanted to talk about the political environment. Again, not from an investment standpoint, but just because I know you're concerned about it, I don't think it's going to have much of an impact from an investment standpoint on us, because the great companies that we own, if you look at all the companies that we own, many of which have been dealing with higher taxes in a semi-socialist type environment in Europe, like Unilever, which makes Dove soap, or Nestle chocolate, or GlaxoSmithKline. Well, they're going to find an outlet for their products across the globe, regardless of the tax regimes. So as patriots, worry about those things, but as investors, don't worry so much about the debt situation. Okay, let me go over, talked about jobs slowly recovering. It's going to take some time for jobs to come back. But the good news is I think they're coming. Inflation is here because people are starting to fly again. I see that every 2 weeks as I fly back and forth. People are getting and going back out again, and that's really positive. Although it has fallen off in recent weeks, we're not seeing people go out to restaurants as much because of the Delta variant, and people not flying as much. And business travel is down significantly. Delta and United expect it to be up 60% by now. Where it was, it's still at about 40%. And I'm not sending our guys out that near as much. We're just not traveling as much. Although Lori's going to be getting on a plane going to New York for an investment conference we have in New York City in 2 weeks. But most of our travel has been pretty muted as companies. And by the way, this is very good for corporate profits. When you look at corporate profits, not only are Americans doing better because their personal savings rate has gone up tremendously during COVID, corporate profits are doing fabulously. And corporate profits are the mother's milk, earnings are the mother's milk of stock prices. Eventually, over longer periods of time, stock prices follow earnings. In the short term, it's just a fear machine or a greed machine in the short term. And the good news is that corporations are realizing, companies like ours, that we don't have to have people work in New York City. We don't have to pay for New York City rent. We don't have to pay New York City wages. We can just have our people go live in cities that they want to, like Salt Lake City or Austin, like our fixed income portfolio manager does. Zach works out of Austin, Texas. And they can live in anywhere in the country and live better, higher quality lives. And this allows companies to decrease their footprint, thereby saving them on expenses. and also save them on wages, which is a huge component of any company. It's my biggest expense is my people that I'm paying for, and they're worth it, but it's a big expense. It's like by far the greatest majority of our expense of the company, and it's most any company is like that. So this has been very beneficial for corporate profits. And lastly, I just want to talk about what we're doing from a, I expect earnings to be very strong this year as we recover, although again, it's going to go in fits and starts with the Delta variant. We're not going to buy off on those growth stocks. We're sticking with value and our kind of stocks that produce continual income to our clients. We think that international stocks are going to do very well eventually. These things go in long-term cycles, and U.S. stocks have massively outperformed international stocks over the last decade. But if you remember, the 2000 period, or if you remember, the late 80s, international stocks outperformed pretty significantly during those periods. And again, this has been a massive outperformance of U.S. stocks over international, and we may see that flip. It hasn't flipped this year. It may flip going into next year, though. And then again, international stocks look much cheaper than their U.S. counterparts. And I think the interest rates are going to stay low for a very long time, so it's very hard for us to find any value for you in the bond market. Even high yield, we're only getting 4 to 5% yields on the bonds that we're buying for you, the Goodyear tires, and you see those bonds as we purchase them for you. Because of that, right now, I would rather own a Procter & Gamble or a Pepsi or a Coca-Cola or a McDonald's for you, yielding a 3% dividend yield, versus owning a 4% yielding bond where we could have a default. It could go bankrupt, whereas the likelihood of Procter & Gamble going bankrupt is much less, and you get a better tax rate, obviously paying at on average 20% on taxes on the dividend versus the income from a bond. So that's why we're leaning, and that's why right now we're effectively at a 75% stock allocation, because the current yield will generate the future return. And with current yields at extraordinary, if we were back in the early 80s when we had 16% CD rates, you can get a 16% return, over a 5-year period or whatever period you're willing to buy that bond for. We're starting at exceptionally low interest rates, which means no return really for the bond market for safe bonds. So we're not going to buy U.S. Treasuries for you. We're not going to buy municipal bonds in North Carolina or New Jersey, because there's just no value to be found in that sector for our clients right now, our investors. So again, we're at about 75% stock. You see we're at a little over 55% or 54% in U.S. stocks, 25% international, and about 20% in our bond portfolio. Our yield right now is down to, I had a client conference call with Greg and one of our clients this morning. We're at about 3.7% on our portfolio. And that's the good news is because stock prices have gone up, the yield has gone down. But the current income that your portfolio is generating is staying similar to what it was about a year ago. It's only down a little bit because of we have more stocks than bonds. So if you look at, again, the most important slide that I brought up earlier, our income is effectively the same as it was for you. It's just that the portfolio value is so much higher that the yield has gone down. So if you look at the yield of the portfolio, that's gone down from 5% down to 3.7, but the actual income being paid to you, if you have $1 million today, it's worth 1.2, but your portfolio is still paying you around $40,000 a year in actual income. And I suspect, and what we're looking at is always companies that continue to try to increase their dividends over time. That's an important component of what we're doing. And at that, I'm gonna unmute everybody here and throw it out to any questions that you may have. Does anybody have any questions? I covered a lot of stuff there. I figured I had to be off by 8 o'clock with the football games coming and the U.S. Open coming on, and I figured I better be done by 8 tonight. So.
Hi, Jim Russo.
Hey, Lisa, how you doing?
Bye.
Good to see you.
Good to see you. Wow.
Haven't seen you in a long time in person.
I know. I did not see you a long time, Jim Russo.
I know. Does anybody have any questions or something? I couldn't have covered everything that was on your. Maybe I did. All right. I covered everything I wanted to talk about. Let's say inflation. Rob, can you think of anything? You got any questions that right now that I didn't cover? I know inflation's a big one. Debt, COVID. Anything else that you're hearing about? I think I should cover.
It's I've mostly just been getting general outlook questions, what we think is going to happen since stocks have had such a big run up over the past 12, 14 months.
Yeah, valuation. I know I talked about valuation. Again, our stocks, I believe the overall market is overvalued. And if you look at the market right now as a whole, you'll see that we do scenario analysis every quarter. And stocks could certainly go down. You know, they could go down as much as 30 to 40% over the next 5 years. That's a possible scenario. That's the bear case scenario, your garden variety recession. I don't think that that's probable. I think that that's a 10 to 15% possibility. Nor do I think that the bull market, you'll hear plenty of people say this is the greatest time to invest and we should be, investing right now, and where stocks make 40, 50% over the next 5 years. I think the truth is likely in the middle, and I think because of those huge tech stocks, that the return for the market as a whole is somewhat overvalued. That said, I don't believe our companies are. If you look at our companies, they're selling at about 15 times earnings, which is, from a historical standpoint, very justifiable. And I would say that especially our European companies, especially healthcare companies right now, where we have an overweight to a lot of the healthcare companies, where we own Pfizer, we own Johnson & Johnson, Merck, GlaxoSmithKline, Sanofi, foreign companies overseas. I think it's very, very attractive. I think it's, that sector looks good. The area of concern for me, again, is fixed income. There's just no return for us with safe bonds. And I don't think there's much, I don't think there's much even return for us in the high yield sector. So we're not finding as much value here, which is why we're only at 20% in your portfolios. All right, let me unmute everybody again here. Any other? I know we're up 12% or so this year, and everybody's kind of somewhat happy but very cautious. But of course, we could just easily be down 12% this year, and I'd be saying the same thing. Listen, hang in there. We're going to eventually recover from COVID. I know we're down 12%. I know it's painful. It feels painful. The amount of happiness that we feel on the upside of being up 12% is not near as much as the pain, literal pain that we feel when the market is down 12%. As it was last year, and more so, 20%. So I know that now people are somewhat comfortable, although not completely. But hang in there. The nice thing about our strategy, I was talking to a client. He's like, "Hey, how about Fisher Investments?" I'm like, "Listen, Fisher Investments they like us. They're a fiduciary like us, and 99% of wealth managers out there don't manage money. They're not asset managers. Fisher is." But what makes us different than Fisher is they're going to buy those high growth and momentum style stocks that we're not going to buy. I'm not going to buy Amazon for you. As much as I admire Elon Musk, Jeff Bezos, we're not going to participate and sell, and pay 100 times earnings for a company that doesn't pay you a dividend. And that's a discipline that we, that slow and steady aardvark is always what we do for our. The other thing that we do that Fisher can't because they're too big is we can buy individual bonds for our clients where they can't. And we've done that over the last 2 decades. We've continued to pay our clients. Those who reinvested the dividends and interest really benefited from that. And those who just took out 4% a year still have more than they started with 18, 20 years ago.
Say, Jim.
Sir.
My name is Joe Amy. I had a question. It took me a while to get myself unmuted. But you pointed out the anomaly of the aggressive spending in a recession. Looking forward, what do you feel will be the impact of that what is an apparent anomaly?
Yeah, the spending has been really interesting. That the government immediately moved in. They basically took the playbook from the financial crisis and passed the COVID relief. And the Fed, of course, the Federal Reserve, immediately moved in and started even buying bonds this time around. And because of that, what we saw was consumer spending, if I could find the chart here, actually went up during a recession, which it has never done. And I think with your question being, what's the impact of that, is it's a good social question, is that can government and the Federal Reserve lessen the impact of recessions? And the answer is possibly. We've seen the impact of, it used to be, I mean, you can go back to, you know, Marie Antoinette and let them eat cake, to the Hoover administration really not doing much during the Great Depression. And economists today have taken more of a Keynesian approach, and government has taken a Keynesian approach that let's get money out, let's flood the system with money. The negative of that can be that we even have this new MMT, the modern portfolio theory, which basically says it doesn't matter how much the government spends. The impact of that is that it could, you know, the PhD I'll never get and the Nobel Prize I'll never win because I don't have the time to do it, is that capitalism is based on confidence. And when investors lose confidence in a nation, such as Iceland, even when they have 30% debt to GDP, or Ireland, when they only have 30% debt to GDP, those economies can collapse when people lose confidence in it. Whereas people haven't lost confidence in Japan, which has had 200% debt to GDP. So the question is can American politicians screw up the natural advantages we have as Americans by spending too much? But the question mark is, because capitalism is a new 300-year endeavor, 300-year, you know, experiment, is what is the right amount of debt? And you know, most of the time you see the same argument going on with taxes in the Laffer curve, right? Of course, if you tax a nation zero, you get zero income tax, and if you tax somebody 100%, they're not going to work. They're going to go somewhere else, and you wind up with 0%. So Democrats and Republicans will fight over a tax rate between 28 to 36%. And, you know, they'll fight over that until they find an equilibrium. Now, when you start getting out here, when it gets to be too much, I don't know what the too much is, but too much is clearly, you know, over a certain amount that starts to disincentivize people taking risk. And so I think that your question has, Mr. Amy, more to do about the social question and the collapse of a nation. Again, as an investor, I know that Coke and Pepsi will find an outlet for their goods and products somewhere, should America even get to that point. We all hope not, you know, just because we have natural advantages here that other nations don't, in that we've got wonderful resources. We have a relatively low tax rate compared to some other places. And we have intellectual capital, which we protect in land ownership here, which many places of the world, like China and Russia, do not. So I think that it would be hard for either party to screw that up, but it's possible. And so I do worry about it also. I hope I
guess that possibility is my biggest concern. But thank you for your thoughtful answer.
Thank you for a good question.
Jim, this is the Lois. Do you minimum wages are now $15 and $20 in fast food restaurants there, and what effect that's going to have on what we pay for everything?
Yeah, hi, Mrs. Weinhold. That's a good question, and I was talking about how my son was making $30 an hour as a busboy this summer at a restaurant, and right now it is starting. We're starting to see wage growth, right? And that's why it's leaking into these inflation numbers. When you see the PPI and the CPI and the PCE index, which is the Fed's favorite index, it's inflationary. There's no doubt about it when you have this higher wage, because you have to pay your people more to get them to come to work. Now, two things that are gonna help this. One is extended unemployment benefits have just been eliminated this week, so I think that we'll see the that wage inflation start to level off, and two, if necessary, the Fed's going to start tapering its bond purchases, and if necessary, they'll start raising interest rates. If this inflation rate stays higher and stays stickier, then they'll be forced to act to maintain price control, so it doesn't get to be too high. They don't mind seeing some price increases right now because we're coming out of a recession, but they don't want to see it stay at a level of 4%. So I think I'm in the camp of it's going to be, I don't know if you want to use the word transitory like the Fed has been using. The Fed has been saying transitory. I think to them that means into next year. I would say the same thing. I think we're going to have 4%, 4 to 5% higher inflation throughout the rest of this year and into next year. And to me, that's the definition of transitory. Is then we'll see inflation start to level off, kind of like we saw with lumber prices this year. They skyrocketed as everybody was building second homes, but then it quickly came down dramatically later this year. Because eventually people say, you know what, that's too much to. Right now, it's too much. I mean, I just bought 2 new computers. We actually bought 5 new computers for our associates and 2 new for 2 new employees. And the cost of computers has skyrocketed recently because of the chip shortage. And as supply lines are rerouted from China to more stable nations that we can rely on as partners, and a lot of these things coming back home, that's going to cause shortages and cause some inflation also. But I think we'll see these things kind of settle down later this year. And you and I hear this from clients too, that auto sales have started to stop a little bit because the price of an auto, just starts going through the roof. And people say, you know what, I really don't want to buy a new car right now. I'll kind of wait off until the price of automobiles comes back down to reasonable levels. And that's the same thing with housing and other things. So my definition of transitory is likely into next year that we'll see that. And Mrs. Weinhold, did I answer your question? I hope I did. Any other questions out there?
Hey, Jim, the COVID, the articles I read, it's never going away. You got Columbia brewing too, that is not being addressed yet. And that's going to be a whole new ballgame.
Yeah, I think COVID is going to be much like terrorism in that we're going to be dealing with this for years, just because of the nature of it. Even with vaccinations continuing to grow and the people who aren't vaccinated dying off, and natural immunity kicking in for those people who aren't vaccinated, we're not going to eliminate it. I mean, Elena's 10, so my kids are vaccinated. Elena's 10, she can't be vaccinated right now. Fortunately, this isn't impacting children very much right now. I don't know if the next variants will, but there's going to be continued variants, and just like terrorism, we're going to be dealing with this. We're at the 20-year anniversary of 9/11 this weekend, and initially people felt like we would never go back to the world we were at, but we kind of got used to it, and we solidified our aircraft and made things safer, and we started congregating again as a people and going to stadiums, and you're seeing that again, right? Tonight's football game, I don't know if it's in Dallas or if it's in Tampa Bay, but both of those states are pretty open, and we'll likely see full stadiums at both of those stadiums. I think we'll see people back. So people are managing the risk, and as a libertarian, and people, you want people to be able to manage that risk and make those decisions on their own. And whether or not some states are, at the conference I'm going to be in 2 weeks, they're mandating a vaccination. I have to show my vaccination card to get in, and you don't have to be masked. It's the same thing for the U.S. Open tonight. You know, at the U.S. Open tonight, you got to show your vaccination card, or you got to show your NYC. Like I've got my my NYC COVID pass, and I pull out my COVID pass, and then I show my vaccination card, and then I could get in, and I don't have to even be masked. Although I think at the U.S. Open, if the cover's down, they want people to be masked. Although a lot of New Yorkers were like, "Hey, I'm vaccinated. I'm not going to do that." You know, so I think that we're learning to kind of live with COVID, and my theory remains that we're going to get out of this. It's going to take some time. It took 2 years with the Spanish flu, and I think that we're a year and a half in now. I think vaccinations have maybe helped us a great deal, in that we haven't had near the deaths. If you look at pandemics, I mean, I'm an economic historian, so if you look at an infographic of history of pandemics over time, COVID is quite small. I mean, here's COVID, right? We've got a lot dead, right? We've got 4.5 million people obviously dead. This has been horrific, but not near as bad as, say, AIDS, not near as bad as, here's the Spanish flu. I mean, look at the Spanish flu. It's monstrous. You get 40, 50 million people, especially when you consider the population was so much smaller in the world back in 1918. This is nothing compared to the Spanish flu. And I think that the vaccinations are gonna certainly help at this point mitigate a lot of the deaths, and that we're gonna grow our way out of this, and then we're seeing the economy start to recover. So again, looking at this as a cold-hearted economist, the personal impact is significant, right? I have a 50-year-old friend right now who's hospitalized and on a ventilator, who's I was with last week, and his daughter and son ice skates with Elena, and 1 minute he's fine, and now he's on a ventilator, and it's just it's very sad. So the personal cost is severe, but from an economic standpoint, I believe we're still going to recover, and vaccinations are certainly going to help that. Any other questions?
Jim.
I promised to be done by 8 Eastern. So.
Jim, Rob Skrotsky.
Hey, Captain, how you doing?
Well, all right. I have to put on my other hat, and I know that interactions with China, the global economy, that China's involved in everywhere. However, looking at the things that are going on, they could make a mistake, especially regarding Taiwan. And there are specific U.S. commitments to Taiwan. Right now, they're discussing commitments to the Philippines, and you could have the Philippines and China at odds with each other. I don't want you to speculate on what could happen, but do you have thoughts about a strategy in reaction to a really catastrophic kinetic event that the U.S. could get engaged in?
Yeah, you could have put me squarely in the camp that both Republicans and Democrats were in, that a intermingled and good trade between the United States and China would be good for both nations. And most of our companies, whether it's Starbucks or McDonald's or banks or Tesla, certainly saw an opportunity to sell to the growing Chinese market. But Chinese actions have been horrific, to say the least, both from stealing intellectual capital to two aggressive actions against the Vietnamese, the Philippines, and the South China Sea, to especially Taiwan. And we own Taiwan Semiconductor, which has been a tremendously great stock for us over the past decade plus. And certainly China would like that, that asset. There is concern, as you have, I'm sure, that if China invaded Taiwan, would the world stand by and let it happen? And the answer is, I don't know. And it probably depends on the administration, and will they do that? And it would certainly cause the stock market to roil in the short term. We've seen it with Hong Kong, in that they've effectively taken over Hong Kong now. But that's just effectively those businesses that were in Hong Kong now have to relocate. I don't think any of this is beneficial to China and what they're doing. Most of the Chinese leaders have seen bringing aboard capitalism, although under one party, they've seen as very beneficial to increasing their middle class. So these actions that China is taking toward their own companies right now, and moving aside their leaders and taking more party control over those companies is, I think, going to be very detrimental. Not to mention, obviously, COVID and the distrust of the world with what's happened, and what China is doing. It doesn't make sense for them to be doing what they're doing. That said, they could certainly do it, and it would definitely cause a shock to the stock market in the short term because it's a geopolitical risk. Longer term, even if they invaded Taiwan and the world stood by and let it happen, other than Taiwan Semiconductor, which we own and would sell, what would be the impact longer term on how many hamburgers are consumed across the globe or how many Starbucks coffees are consumed? The answer is not too much, because those companies will do what they're already doing. They're shifting from China to selling to places like India, which is a growing, highly educated workforce, and obviously growing population that's now also growing in wealth too. And so you're seeing not only supply lines change, where we need those supply lines to be safe for our own medicines and defense, but also companies don't want to have to wait for things to be produced. So they're shifting their supply lines. And I don't think over the long term it'll have much of an impact beyond that initial geopolitical risk and shock of a market sell-off. But there are a whole lot of variables there, obviously, that, as you know, from a political standpoint, that are at play also. But looking at it from a purely economic standpoint, we've been through these types of circumstances before, and I think we would survive a horrific scenario like that also.
I see a lot more interaction now with India, Australia, Japan, and the U.S., which is a good sign.
It is. Yeah, we're moving toward partners that we can trust. And American companies have had to give up so much. Tesla was one of the few that said, no, we're not going to give away all of our intellectual capital to sell cars to you. But then China immediately came up with their, what's it called, XPeng, their own car company, which looks exactly like a Tesla. And they quickly copied the technology, and I think American companies are realizing that now too, that they just can't rely on China being a good partner, and may leave that market to go to other markets, like India.
Yeah, but years ago, I was involved in a war game where India and Pakistan, it was a full-blown war against each other, and it was a colossal global mess.
Yeah, that would be, because it's nuclear, and anytime you bring the nuclear event into play, it's the one thing that keeps me up at night. And I don't worry about nuclear war between even India or Pakistan or China and the United States, because it's just mutually assured destruction, and it's just not good for either nation. I do worry about terrorism becoming nuclear. So if a terrorist nation became a nuclear power, that could cause some massive disruptions to capitalism and the globe. And we're probably, fortunately, it's not easy to do. So we're probably a decade or two off from that possibility, but it's a worry that I have a decade or two into the future.
It's coming up on 8 o'clock. We'll let you go, but what's your perspective, since you brought it up, about returns from the defense industry?
Yeah, right now we actually don't own any, Lockheed or Raytheon or I think they're a bit pricey, the companies. If you look at, just to bring up, one, I'll bring up Lockheed, since I flew the C-130, and I have my beloved aircraft, which I saw pulling Americans out of, which is something I was involved in the Congo and in Albania, and helping Americans get out of some rough areas. But if you look at a company like Lockheed, which again I love, it's a great company. It's not exactly cheap, but not too bad, right? It's got a nice 3% dividend yield, and it's selling at about a reasonable valuation at 12.5 times earnings. So you might see us swap. You might see us swap some of the more expensive, like a Taiwan Semiconductor, which has had tremendous gains for us, for a company like Lockheed. It is looking a bit attractive. You can see this year, Lockheed has not. It's done. Fortunately, we haven't owned it. You can see it's down this year when our stocks are up. Here's Gilead Sciences, which we own, and I think because it hasn't participated this year, like much of the healthcare stocks, by the way, healthcare stocks that we own, a lot of them have not participated this year either. Like let's say like a GlaxoSmithKline, which you can see is only up 8% comparatively to the market, which is up higher this year. So I think that it's starting to get. If I showed you like a 2-year chart of Lockheed, defense stocks are starting to look a little bit attractive now. I bought defense stocks when the Obama administration came to power. Everybody thought, well, we're not going to need defense anymore. And I thought, well, that's silly. The world's not any safer. And Lockheed and Raytheon and Northrop were selling at 7 to 8 times earnings with 6% dividend yields. And we subsequently made 180, 160, 140% in those 3 companies that we owned at the time, and then sold them because they got too pricey again. And at this point, as you can see, Lockheed over a 2-year period hasn't done anything, and even a 5-year period. Fortunately, we haven't owned, these companies because you can see Lockheed was flying higher there for a while, and then it's kind of come down in the last 2 years. But it's starting to look a little bit more attractive to us. So I think that you may see us purchase some defense companies in the near future. Something that we're obviously always looking for opportunities. So especially if we see a sell-off, then it could become more attractive to us. That's a great question, though.
Okay, thanks.
That's the stuff I'm doing late into the night, debating myself and then our investment team of whether or not we should own a particular company. And I all I'm doing all day long is which is why I got so many great people around us, is just looking at earnings reports and valuations and digging into a company like Kraft Heinz that we own and making sure they're paying increasing dividends and how are things selling, and looking at their financials and looking at income statements and balance sheets. And this is the stuff that I enjoy. Being a hardcore introvert like I am, I could talk about these companies all day long, but I don't want to put everybody to sleep, so I'll leave it.
Thank you.
Good show, Jim.
All right, thanks, Colonel. Well, thanks to everybody. It's nice to see you. For those of you who
thank you, Jim. We appreciate your time. Thank you so much for what you do for us.
Thank you, guys.
Hey, Jim, can you hear me? Joe Uzart. Jim?
Oh, there you go, Joe. I couldn't hear you. I couldn't hear you earlier, but I can hear you now.
I tell you, I'm having